When people hear that banks have the ability to create money, it's often met with disbelief. The idea brings forward thoughts of vaults full of cash being printed at will, an endless supply of money flowing freely. But the truth is far more complex. Yes, banks can create money, but it is far from the unchecked privilege that some people imagine. In reality, the process is tightly controlled and fraught with responsibilities and risks that banks must carefully navigate. At the heart of the matter lies a simple truth. Banks create money when they issue loans, but they don't do it by printing banknotes. Instead, they add a number to your deposit account, a digital entry reflecting the loan you've taken out. You might never even see physical cash. You simply walk out of the bank with a promise of credit. This process is made possible by the fractional reserve system. Banks are required to hold only a small fraction of their customers' deposits as reserves, meaning that for every dollar deposited, they only keep a portion in reserve. The rest is used to issue loans to other customers. For example, you might deposit $100 into your account, but the bank may only need to hold 10 in reserve. The other 90 are free to be lent out. Crucially, this means that deposits, the money you and I think of as ours when we check our bank balances, are counted as part of the money supply. But the most important takeaway from all this is that those deposits are liabilities for banks, not assets. This is where the responsibility comes into play. It is an asset for you, but it is a liability for the bank. A bank owes you that deposit, and they need to be able to pay it out when you demand it. So, while they're creating money in the sense of increasing the money supply, they're also taking on significant obligations. When a bank issues a loan, the resulting deposit in your account isn't free money. It's a liability that the bank owes to you. The bank, in turn, relies on its borrowers to repay their loans, allowing them to maintain enough liquidity to pay back depositors when they need to withdraw money. This is one of the biggest challenges for banks, managing liquidity. Banks need to have enough liquid assets, like cash, on hand to cover the demands of depositors, even while much of their money is tied up in long-term loans. If too many people want their deposits back at once, a bank run, the bank could face insolvency. Liquidity risk is always lurking in the background, a reminder that banks are balancing a delicate equation. On top of this, there's credit risk, the risk that borrowers won't repay their loans. When a borrower defaults, the bank has a problem. Not only does it lose the expected repayment, but the deposit associated with the loan is still a liability. It's a double hit, and managing this risk is one of the core tasks of any bank. Now let's step into the shoes of a typical borrower. When you take out a loan, the last thing you want to do is leave it sitting in your account. You're borrowing to spend, whether it's to buy a house, start a business, or pay for university. Once that money is spent, it moves through the economy. The person you paid deposits the money in their own bank account, and in turn, their bank might lend it out again. And so the process repeats. This circulation of money creates what economists call the money multiplier effect. A single loan can, through this cycle of deposits and lending, lead to an increase in the overall money supply. But again, the bank is always carrying a liability, and at every step, the responsibility grows. The more money circulates, the more banks need to manage their risks. This movement of money fuels economic growth. It funds new ideas, investments, and businesses. When banks lend responsibly, they aren't just adding numbers to accounts. They're helping to drive the real economy forward. But with every loan, they are also transforming short-term deposits into long-term investments, and this requires careful judgment. This transformation of short-term deposits into long-term loans is at the heart of what banks do. When they lend money for a mortgage, a business loan, or even a car, they're taking short-term deposits and turning them into long-term investments. In doing so, they provide the financial support that fuels innovation and growth. A world without bank loans would be a world without startups, without home ownership for most people, and without the investment needed for infrastructure and business expansion. The role of banks in funding these ideas is enormous. They enable individuals and companies to take risks, invest in the future, and ultimately drive progress. That's not to say that the banking sector hasn't got a lot of flaws. Unrestrained risk-taking fueled by large, no-strings-attached bonuses led to a lot of unsavory behavior at the turn of the millennium. Then, when the inevitable crunch came and bankers approached the government asking for the taxpayer to pick up the tab, while other industries had to fend for themselves, their reputations reduced a lot further, an awful lot further. There have been a lot of changes since then to reduce risk and leverage, and to link bonuses to long-term profitability. More probably needs to be done. But don't be misled by fantastic stories that banks can just create money. Far from an unchecked privilege, the ability to create money is a service that must be carefully managed. When done well, bank loans help power economies, fund new ideas, and drive progress. So regulate banks, ensure the right incentives are in place, but don't try to stop them creating money. A link for the next video should be on your screen now. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.